Most people don't walk before they crawl, and you can't bank on the cash value of life insurance until you build a reservoir of cash.
You are listening to Wealth Talks with the McPhees. Owning participating whole life insurance is a powerful way to generate more money and to recover the cost of acquisition over time. But it does take time to develop, patience to build that foundation.
Too many people want to jump in and just start banking right and left with the cash values, and they haven't even learned the fundamentals of how a life insurance policy works or how the IRS requires the structure of these policies to keep the money from being taxed again. So we have to be really careful in how we set up and design these, and we have to be patient, and we have to be determined that this is the best thing for us to do. So let's talk about what helps people to become and build that determination that, yes, we're going to do this because this down the road is going to be the very best thing to create wealth for us.
Yeah, this really is the central theme of what we do at Life Benefits, helping people to get this foundation, get from where they are now to a point where they have a foundation, they can do a lot of other things in their financial life. And those of you who listen to this podcast on a regular basis, you know that we talk about a wide variety of topics, subjects that relate to this central theme. And it's always good to revisit that central theme from time to time so we understand what is the foundation that we're building on here.
You can't build a castle in the air without a foundation. You can start building the dreams, but if you don't lay the foundation, that castle is never going to appear. Mm-hmm. So what is the foundation, Michelle, of banking with life insurance, cash value life insurance?
Well, the foundation, you need to have a well-designed policy, a whole life insurance policy that when you pay your premium, you're going to have cash value develop. And it's got to stay, like you said, within that IRS guideline or it becomes taxable. So we know how to design those so it's not going to be taxable. You're going to get the most cash value possible for the amount of premium dollars you're paying. And so you start developing a reservoir. And that reservoir will be small at first. It takes, like you said earlier, a long period of time to develop a large reservoir. But if you never get started on that journey, you never take that first step, you'll never get to where you want to go. So you can take those initial steps. They are going to be impactful. And then eventually you will realize you have gone quite a long ways or develop quite a reservoir.
So you talked about design. Are we looking for a policy that has really super high dividend promised? Are we looking for something that gives us a contractual guarantee that if we pay this money is going to be there according to a legal binding contract?
So that's a good point because dividends are never guaranteed. So if we're just running and chasing after, this one shows really high dividends, well, that's great. That's our pie in the sky, kind of our castle in the air, but what is guaranteed? We always want to look at the guaranteed values and make sure that we're getting the highest guaranteed values possible. And when I say possible, we want it within the IRS guidelines. We also want it so that our premium dollars are purchasing the most cash value possible. And sometimes there's other designs out there that will artificially inflate the death benefit, and we could get into the insurance terminology, but sometimes they try to artificially create extra cash value in the first year, but it comes with a cost to it.
It does.
So it's really not as cost effective.
So we're talking about, when we talk about a whole life policy that's designed to build cash value, there's some ways to trick the IRS formula, and those don't always pan out in the end. And here's why. There's two parts to a whole life policy that develops high cash value quick. There's base insurance, which the IRS requires to even qualify the policy as a whole life policy, and that's what gives it its tax preference status. And then money that, once that base death benefit has been established and paid for, then the IRS allows a certain amount of money extra to go to a rider that immediately produces cash value. Now, some people try to fool that IRS formula by reducing the base and adding term insurance. The problem with that is term insurance always remains term. It never, ever creates anything but term insurance. Whereas base insurance over your lifetime is like a mortgage. It eventually gets paid off. And as it gets paid off, it produces cash value too. So the term actually increases the cost of the insurance and decreases the total internal rate of return of the policy over its lifetime.
Yeah. So that may sound a little bit technical if you're not familiar with some of these terms, but let's take a little trip back in history to understand, how this concept came about. So R. Nelson Nash wrote the book Becoming Your Own Banker. I think it was in the late 90s. It was based on a concept that he had realized in the early 80s. He had bought a lot of real estate and had larger loans outstanding, and then interest rates started going up.
Well, and he had done what some of those real estate gurus talk about. You buy a property, then you leverage that to buy the next property, and so he had quite a bit, quite a few properties, but he also owed a lot of money.
And it was raw land that he was buying, so there wasn't really any return on that property. It was just all outgo.
Yeah, so not a lot of cash flow. So what ended up happening here is he needed money to pay off the snakes and dragons.
That's what he called them,
the bankers. Yeah. And where was he going to get it? And he said that the question was doubtful. It's doubtful that he would have seen the answer to this question unless he had been accustomed to paying large life insurance premiums. You see, his brother had been a life insurance agent, had sold him a number of policies. I remember one of those policies was with State Farm. But he was able to see, because he had been paying these large premiums, he was looking at the cash value development, that he could access money from 5 to 8% to take a policy loan and then go pay off the snakes and dragons. Now he basically transferred that debt to a lower interest rate. And so he started looking into it a little bit deeper. He said it's doubtful he would have seen that message unless he had been paying some higher life insurance premiums, had built up those cash values. And that's an important lesson for us today, because we still have to build those cash values. Take the time to build those cash values today.
What Nelson did for us in writing Becoming Your Own Banker and the teaching he did, he taught us that you don't have to wait for years and years for cash value to build up like it's in his State Farm policy, because State Farm doesn't have a paid-up additional rider for insurance. So he propagated the idea that if you buy policies with companies that have that rider and fully fund them, you can have more cash value in your policy than what you've paid for it within 10 or 12 years. You don't have to wait 20 or 25 years.
So something I remember when we first read Nelson Nash's book back in 2005, we looked at the numbers he was showing in his book. We were starting to understand the concept of what he was talking about. And I remember having the discussion with you, Tom. We thought, by what he had presented in the book, we thought it was going to take 7 years for us to have any access to the cash values. And you and I agreed this is worth it.
It's worth the cost.
We can go ahead and be putting money away for 7 years before we get to touch any of it. And much to our amazement and excitement, we didn't have to wait that long. In fact, most people, can access cash values within 30 days of owning a whole life insurance policy.
And that's a healthy and sustainable way to accelerate a policy. You were talking just a second ago about, the people that add term riders and try to accelerate that cash value even beyond what the paid up additions rider can do. That's a little unsustainable. It does come at a cost.
And a big risk, because those dividends, they're counting on dividends to build that price, that cash value quicker when they do that.
There's a balance, but using a paid up additions riders is a great way to get extra cash into a policy. It still takes some time to build. You do have to have patience before everything that you've paid in premiums is going to show up in cash value. That usually takes 10 to 15 years, somewhere in that range. But you can start using it within 30 days, like you're talking about. You can use a portion of that.
Yes, because Tom, you often talk about the reservoir at Hoover Dam here, that they built Hoover Dam and then they started filling up the reservoir, but it took 7 years to fill up. And, you can think about this in your own home, in your bathtub. You're eager to take a bath and you turn that water on. get the temperature adjusted. It's going to take a while to fill that whole tub up. But you can get in
Before it's full.
Before it's full.
Sure.
And start getting wet and accustomed to the temperature, making your adjustments. It's still going to take a while, but you are technically in the bath.
Now, Michelle, you talked about Hoover Dam and filling the reservoir. The nice thing about a life insurance policy, the dam's already built. We just have to go purchase it. We don't have to go through all the steps that banks have and insurance companies have to go through to get their charter to do business.
That's
true.
That's
That's a long process. It's very expensive, and you have to have 20, 30, $40 million sitting on the side that's not doing anything to even get those charters.
That's kind of like building the bathtub. We don't have to build the bathtub. We just have to turn the water on. And we can choose how far we're going to turn that flow on.
We can just mutually join the insurance company that's already built the dam for us, and we can immediately start filling our reservoir with this paid-up additional insurance rider.
That's right. So the next then comes the question, well, why use the life insurance, right? Because we could sock money away into a bank account.
Sure.
And we could use that money along the way. In fact, Nelson Nash talks about a concept from the corporate world called economic value added. Corporations were using their own money and acting like it didn't have any cost whatsoever. But if they had to borrow money from other people, of course, they had to pay interest. So there is an idea here that you should treat your own capital like there is a cost to it, because there really is. Corporations who recognize that, started seeing better profits.
And we're talking about corporations like Coca-Cola, Johnson & Johnson, Procter & Gamble, Briggs & Stratton, all these big companies. They, until about the 1990s, just thought nothing of spending their own money and never seeing that there was a cost to it.
So just socking money away in a bank account is kind of like not recognizing that your money needs to be at work for you while it's being saved up, because what do you get in a bank account? Not very much. So that's where the concept of using the life insurance comes into play. What makes it different when we build up money over time in a life insurance policy and take a policy loan versus just storing some money in a bank account and using it this way?
Well, if we put money in a bank account and we need to use it, we have to withdraw it. Now, granted, we could go to the bank and say, okay, I want to use my savings accounts as leverage and borrow money from you, and they will hold your savings account, and you can't take anything out of it when you do that.
Right.
And then you would pay interest back to the bank. Well, you're not a mutual owner of the bank, so you're just profiting the bank that way.
Sure.
They get a profit off the money that they're putting a hold on in your savings account. They get a profit on the interest that you have to pay them.
So you would earn whatever interest you could get on your savings account in the meantime. Okay.
And in the meantime, if you did a good investment with that borrowed money, you would get a return on that, or you'd have the asset you purchased with it. Well, in a life insurance policy that's mutually owned and is selling participating policies, when you pay that interest back, yes, you go to the bank, the life insurance company, you say, I'd like a loan, and they hold your cash values in your policy, and it continues to grow just like it was guaranteed to, and it gets dividends that are promised to it, okay? And then when you pay the interest to the insurance company for the use of their money, it makes them more profitable than they would have been otherwise, because the money they loan you is money that had to be kept in that reserve account, that $20 or $40 million that we talked about earlier, okay? And now, because you're a participating owner of the insurance company, you get to profit off the interest you're paying for the loan you borrowed, for the money you borrowed.
Yep, that's pretty good.
That's great. Yeah. And so let's just think about this for a second. If you took a chunk of money, and earned 5% on it for 7 years, that money is going to grow and compound over that 7-year period. If you borrowed the same amount of money and paid interest on it over 7 years, let's say it's the same interest rate, let's say 5%, you're going to pay some interest on that. But because of the cash flow difference, one is compounding on an ever-increasing basis, one is decreasing as you pay the loan off. That cash flow is something that automatically happens in our life.
It does.
Already. And so why not profit off the difference? And that's what this allows us to do.
And here's the really fascinating thing, and here's the banking aspect of it. Every time you take a loan from your cash value life insurance policy, you need to make sure that you're taking enough time to pay the loan back so that the compounding in the policy the growth you're earning in the policy is going to offset the cost of the loan, or the interest you're paying back is going to do that. Otherwise, everyone says, well, you just borrow from it and pay it back. No, you've got to do the calculations to make sure this is going to be a profitable situation for you, because not every loan that you take should be from your life insurance policy. And that's really something that a lot of people are falsely proclaiming.
Yes. So let's look back. Let's look at the last 20 years. We've been in an environment of very low interest rates for
Yes.
much of the last 20 years until the last couple here, when we've seen interest rates start rising again. So a lot people would say, well, why? I don't need to use my policy right now. The money's just sitting there. I'm not really utilizing this concept to its full potential. Well, just having the money sitting there in that type of environment could definitely be using it to its full potential when they're able to get loans at lower interest rates somewhere else. Mm-hmm. But now that interest rates are going up, we're not getting that question so often because people are seeing the value of this. That now that all that money that was just sitting there, it was earning a return. It's still available to them even now that interest rates are going up. They can access that money, pay off some of those loans that are higher interest rates, pay off those snakes and dragons. Now they have the best of both worlds again. Mm-hmm. So it's life goes in cycles, finances go in cycles. Having a reservoir of participating whole life insurance allows you to be prepared for those cycles.
Absolutely. And it gives you more opportunities. Opportunities come along in lifetime, and if you don't have the capital to take advantage of them, they often don't knock on your door again. Mm-hmm. They pass on to someone else. So having the reserves, having the dam that is already built for us, the policy, all we have to do is tap into it and start filling it up. And this takes us right back to our fundamental principle that we repeat over and over and over again out of The Richest Man in Babylon. You need to be keeping 10% of everything you make. Not save it, but keep it. And the safest and the most secure place to keep it right now that gives you full access without penalty, without fees, is participating whole life insurance.
That's right. Now, something you may have heard is that, a return on a life insurance policy might not do as well as a return in the market if you could earn 6 to 7% in the market. So let's think about that for a second. Investing in the market is more of investing, not so much savings, because that value could be up or down when you need to get to the money. Mm-hmm. So it's not really a steady reserve like participating whole life insurance cash values are. The other thing is that it doesn't give you a permanent death benefit by investing in the market either. And people will say, well, you could buy term and invest the difference, but that's kind of like always renting your house because there's going to come a day when you won't need it after all.
Yeah. Or renting every house you go on vacation. Instead of renting every house, do you buy every house you go on vacation and spend in?
Well, that's the other extreme. No, you don't do that either. So that doesn't mean that all of your life insurance should be permanent life insurance either. For a lot of people, it's going to be a combination. Make sure that you have some ownership here, but you might have some term insurance as well during your lifetime.
We talk with a lot of real estate investors, and it's fascinating to see that all things considered, if we're just buying a mortgage, if we're just paying a mortgage down and the market stays flat and we're not seeing tremendous, ups and downs in the market, the equity in a life insurance policy designed like we've talked about today will produce equity faster and much greater than a piece of real estate. And so when we look at that, it gives us more incentive to be patient.
That's true.
To realize, we're going to do better long term this way, and we'll just, as time goes on, we'll be able to do much more real estate deals if we build this life insurance first.
That's right. So just as a quick recap, some of the benefits of using life insurance for this reservoir instead of a bank account. Obviously, you have the permanent death benefit. That's kind of like a bonus in here. You get to keep a guaranteed return on it the whole time. It's not going up and down in the market. You can take a policy loan to make a same type of investment that you would make, if you were using a bank account anywhere. But you don't have a loss in liquidity when you do that, because your money is still gets to keep growing with the life insurance company, because you're really not taking your money. You're leveraging the life insurance company's reserves, keeping your money as collateral. And finally, you have the potential to earn dividends. When the life insurance company makes a profit, you're a mutual policy owner. You get a portion of that profit through your dividends.
Those are the same points that John Wanamaker made in the early 1900s, being the most insured American person in the world at that time. And those are the exact same things he told the reporter who asked him, "Why do you have so much insurance?" Michelle, I remember when we were first starting, you were so excited because we were going to be able to save and spend our money too.
Yes.
And that was an interesting concept, because nowhere else had we been able to do that. We had used CDs, we had tried to do real estate, and we're fairly successful at that. But the life insurance has given us the foundation that has allowed us to do much more with that castle in the air that we've had, that we're building.
I've been a little bit quiet here. We're talking about all the financial aspects of a whole life insurance policy and how you can use it during your lifetime and access it and still have growth and all these things that are so wonderful about whole life insurance. And the thing, though, that we can't overlook is that death benefit.
Yeah.
And
Yes.
as we've been sitting here, I've been a little bit quiet because my mind is going to our different clients who have needed to access that, family of Peter and Jared and Patrick and Beth and David, because none of us are getting out of here alive.
Mm-hmm.
And even though they accessed and use the funds in their policies, they left a death benefit for their family.
For pennies on the dollar.
For pennies on the dollar. And then, John, a moment ago, you said that people want to know, well, what is the return on life insurance? Oh, we can tell you the very best way to get a return on life insurance. And that is to take out the policy, purchase it, and then go die the next day.
I don't think anyone wants to do that.
We don't recommend it.
We don't work with people that want to do that.
We don't recommend that. That's not the kind of returns that we are looking for. Mm-hmm. And so, but if we can use whole life insurance that does provide a good return, that does take care of your family for pennies on the dollar for you, then whole life insurance is a great thing to use even during our lifetime.
Sure
I'm thinking of a gentleman that's in his 70s, and he's single and has no kids. And when we talk to him, he always says, everybody needs life insurance. Everybody does need life insurance.
Yeah.
And he has really nobody to leave the death benefit to, but he realizes that his business interest and his partners and even a sister of his, that he knows that he has this obligation to them, that he wants to leave them better off when he's gone financially than while he was here.
And in the meantime, he gets to profit.
Mm-hmm.
Absolutely.
Enjoy the profits of using the whole life insurance, the cash values.
That's right. And something that I don't think it would be complete here if we didn't talk about the fact that people want you to rent your insurance your whole life, the term insurance. The reason that they base that on is, well, if you get to the point, that your investments have grown enough, you're not going to need life insurance anymore. And it's true that some people may not need as much life insurance at a certain point in the future. That makes sense that some of it could be term insurance. But have we really ever talked to anybody that carried life insurance throughout their lifetime to protect their family, and then when it's going away, if it was term insurance, when it's going away in their 60s or 70s, I can't think of anybody that we've talked to who didn't really want to keep some of that.
No, and what's the saddest is when they're no longer insurable. We were talking to one of our clients the other day. He wants more life insurance. He definitely wants more. And he's been very financially savvy, but his health is not where it needs to be.
Or the couple that came to us that were referred by the insurance company because their term policy was running out on his life. And he's now in his mid-70s. And when we told him that the cost of insurance would be so much more at 75, 76, he was visibly shaken because he realized he had nothing to leave his spouse and children.
So
Yeah, that's a predicament that people that buy only term insurance are going to find themselves in sooner or later if they live that long. Which most of them, I think, hope to do that. They hope to live that long.
Well, in our continuing education, I was taught this last time taking those courses, 70% of Americans will not be able to leave an estate without life insurance.
Wow. There's another story that that relates to this that I'm just thinking of here, and that is somebody that bought term insurance, and it was running out. They knew they wanted to benefit for their family, and they kept kind of joking to their family that I just got to die before X date, and it turns out they did.
yeah.
It was like a mental subliminal programming. You know, they're healthy, you know, everything. They could have lived beyond that, but somehow they had subconsciously limited themselves to that date, and sure enough, they died in time to collect the death benefit.
We talked to you talked to the adult child
Yeah.
of that person, and she was very grieved, feeling that that's really was the
He had
mindset
limited
that
himself. Yeah.
he was limited because he wanted to make sure his family was provided for, and he knew that just that mental thing, like you said. No, he did not take his own life.
No.
He
Just
it was
natural
just
causes, but you know how much of that was subliminal
mental
mental
emotional
programming.
thing.
Yeah.
So
You know, a lot of people say, well, if I buy insurance,
you don't
I'll be
wanna be
worth
that.
more dead than alive. I hope I am. I know I am financially. And of course, I'm much better off when I'm dead anyway, because I'm going to a better place. But anyway,
well, I don't know about the rest of us.
we want to leave more to the people that we love
Yeah.
when we're gone.
Yeah. So
That's
on
right.
an up note, so that kind of makes us feel kind of down. But on the up
Yeah.
note, hey, if we'll just take care of it now,
Yeah.
we don't have to worry about it.
Buy some permanent insurance, and then you don't have that pressure.
It's like putting fire extinguishers in the kitchen, talking about a fire escape route if something were to happen, and then once you've talked about it and made the plan, you can go about your daily life
Yeah.
and not worry.
Yep.
So
That's right. So a great resource that you can look at based on our conversation today, our book, How to Build Sustainable Wealth. You can get that on our website, life-benefits.com, or call our office at 702-660-7000. You are listening to Wealth Talks with the McPhees. Have a wonderful week.